Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been reading his articles on the gold market, gold stocks for years. He is a chartered financial analyst, and he ran the top gold stock fund, the Tocqueville Gold Fund, for many years. Sprott bought it, and now I think it's called the Sprott Gold Fund. He has over 50 years of experience now working on Wall Street, managing other people's money as a portfolio manager. He is currently a managing director at Sprott Inc., which is publicly traded, diversified throughout the commodities complex, as many of my listeners know. Also a senior portfolio manager at Sprott Asset Management USA. John Hathaway, thank you for joining me.
Happy to be here. Thank you.
Now, John, before we talk about maybe gold miners, the gold mining industry, I want to get your thoughts on the global macro conditions. Do you think that the Fed has no good options left as far as rate hikes go?
Yeah, no, they're in a tight spot. We're heading into a recession. If they raise rates further, that deepens that accelerates the recessionary forces. I don't think inflation has been licked. I do think it's going to cool off somewhat, but I don't think the kind of rate increases that they're talking about, 50 basis points, is going to change anything. The one thing that's going to stop inflation would be a severe recession, which is where I think we're headed anyway. I don't think the Fed can do anything about it, but the fact that they're tightening at this stage of the game, to me, shows you that they're essentially clueless. And we could talk more about that, but I would say that a recession of the sort that I anticipate will be positive for gold because people will be looking for safe havens, and gold is first and foremost among them.
Even if the recession gets worse, there's a global depression, aren't there still tremendous supply chain problems? There's still cost pressure. There's a new normal of much higher costs for a lot of different businesses, especially commodities businesses, with what's happening with energy markets, with gasoline, diesel, electricity, and then all these supply side problems on commodities. I just don't see deflation, if there is deflation, lasting for a long period of time.
Well, I mean, deflation and the depression is a different kettle of fish. That would cure inflation, but the collateral damage would be, it would be of a 1930s kind of scale. I don't see that. I just think the government will step in, will have fiscal spending that dwarfs what we've seen in the past, to arrest any sort of drift towards proper deflation. But I do think you're going to see a cooling. Oil prices are going down, grain prices are going down, but labor costs are going up. Housing costs are going up. It's a mixed bag. And again, I would not side with those who think that an economic downturn will be the 100% cure for inflation. I think what's going to happen is that the Fed will stop short of finishing the job, because the economic consequences of finishing the job would be what we just talked about, which would be a very serious recession. That would be politically impossible. I just don't think they can finish the job. But I do think that there will be somewhere along the way here, probably this summer and before the midterm elections, they'll declare victory, or they'll say, we've accomplished enough that we can pause our efforts. And I think at that moment, gold will get a second wind, and in my mind, it'll go to all-time highs.
So we're recording this interview on Thursday, August 4th, 2022. The U.S. Treasury yield curve, you have the 2s and the 10s, the 2-year U.S. Treasury, the 10-year they're inverted. I think the inversion's getting worse. And now you also have, I think for the first time in a while, you have the 3-month US Treasury and the 10-year also close to inversion or right around inversion right now. I know you've written articles on this in the past, and I think you also just put out a piece on the Sprott website. Is an inverted yield curve normally good for gold?
I couldn't tell you. I mean, I just don't have it off the top of my head that whether that's 100% kind of proposition. I do think that an inverted yield curve destroys the narrative that's been hurting the gold, which is that the Fed's going to fight inflation and keep on raising rates. I mean, that's been the battle we've been fighting for the last couple of years. So an inverted yield curve tells me that we're headed for recession. And the more the Fed tightens into that, I mean, the worse they look, the more their credibility is damaged, and the more this narrative that's been, frankly, poisoned for gold loses any sort of steam. And that is that the Fed is going to defeat inflation. I don't believe it. I think there are economic forces recessionary forces that will slow the rate of inflation down, but slowing the rate of inflation doesn't mean inflation has been defeated. It just means, and you saw this in the 1970s, that the recession of, I think it was 74, 75, inflation slowed down, but it didn't go away. And what I'm anticipating is that there's absolutely zero tolerance for any extended period of economic weakness on either side of the aisle. And whoever wins the midterms or who comes out on top in the midterms, that remains to be seen. But I do think you will see, should the kind of recession develop that I'm expecting, you will see stimulus checks mailed out the way they did during COVID. And, I think the deficit will blow out once again. And again, I see this all as very constructive for gold.
The gold price has actually responded very well despite the Fed announcing the 75 basis point rate increases. The gold price has actually rallied. It's $1,791 an ounce when we're recording this interview. Are you surprised that the gold price responded so well to the Fed rate hike announcements?
I'm surprised that it did as badly as it did during June and July. And I think that has something to do with the machine traders pushing the price around and just hitting stops. I thought that basically that was the mother of all corrections. And frankly, I'm relieved to see that we're getting some of that correction back. But I still think, the game is far from over for gold. I just want to see, how this summer develops. And if it develops the way I'm expecting, I would think the Fed will have more egg on its face than it ever has had, and it's got plenty now. And, anybody who wants to suggest that the Fed is going to fiercely fight inflation I don't think anybody's going to listen to them. And I think that at that point in time, which is the so-called pivot that everyone's talking about, gold gets more than a second wind. I think it goes to new highs.
Yeah, I think that gold has probably bottomed already, or it's close to bottoming. And then 6 to 9 months from now, when the market realizes the Fed cannot keep increasing interest rates, or they're going to crash the real economy, even worse here in the US, they're going to crash real estate prices. That's going to bankrupt, make states insolvent from home prices collapsing, property taxes, and other tax revenues collapsing. I think that's when gold really takes off. And I think the gold bull market, we might have another gold bull market start over the next 2 or 3 years, a really big one.
Right. Amen to that.
Well, back in you mentioned in June the weakness in the gold price. The Chinese market, we were just getting some of this data. Kitco put out a story talking about the Hong Kong imports. I think in month over month increases over 200% increase in Chinese gold demand for imports through Hong Kong. And then I think over the last 12 months, year over year, I think it's up 300%. So there was a lot of Chinese buyers when the US dollar gold price was weak. They came in and bought that dip very, very aggressively.
Right. Right. I'm aware of that. And that's certainly the case. And typically when you see physical demand in Asia pick up, that's constructive in terms of are we at a bottom or not. But again, I would go back to the machine traders that push the price of gold around without having any physical underlying their position. Is basically one, people with huge amount of credit, and they use gold, among other things, as a playpen to air their macro ideas. I think you've seen that in oil as well, seeing it in grains. You've seen it throughout the commodity complex. So what happens in Asia is, so I guess it's another way of saying that with machine trading being as prevalent as it is, real price discovery is suppressed for a period of time. I mean, nobody in their right mind thinks that these machine traders actually are exchanging gold. They're simply exchanging an idea about gold. And of course, that idea during a period of Fed hawkishness was to be on the short side of it. And I think that's what we've just been through.
Yeah, I agree. A lot of these global macro traders, these global macro tourists that have these high frequency trading algorithms, as soon as the dollar index rallies, they just sell gold futures. So it's long dollar rally, short gold futures. So that's been the trade now for months.
For a while, but whenever anyone says the strong dollar is a headwind for gold, I have to ask the question: is how come gold is up from 300 to 1,700 over the last 20 years? And we've had periods of dollar strength and dollar weakness. So what you just mentioned, and I agree that that's in the short term influential in terms of how machine traders position themselves. Over the longer term, it's been pretty meaningless.
Yeah, I completely agree. And also the other point is mining costs. I mean, if mining costs are going to keep rising, if the ore grades are going to fall over time, I don't know any gold miners, John, maybe you do, that can mine gold at $300 an ounce or $500 an ounce. Those days are long gone.
Oh, for sure. I mean, that's right. So again, my view on supply and demand of that nature, which is the Asian physical demand you just talked about, mine supply and jewelry demand and all that kind of thing. I think it's important, but I think it is not the main driver of the gold price. The main driver of the gold price is investment demand by speculators. And you see that in the form of inflows or outflows to GLD and other ETFs, gold-backed ETFs. And that's a very powerful force. So I think those flows have been, I don't have it off the top of my head, but I think they've been pretty lackluster over the last couple of months. And I think, frankly, again, the machine trading has scared a lot of investment away from physical gold. But again, when that whole narrative starts to break down, which is what I'm looking for, then I think you'll see very strong flows into gold-backed ETFs, and that will certainly help the price.
Well, the better gold-backed ones are the ones, your company, Sprott, the Sprott Physical Gold Trust. And you guys have you bought the Central Fund of Canada, you have the Sprott Physical Gold Trust, the Sprott Physical Silver Trust, you have platinum and palladium, you just added uranium. So I think Sprott is doing an unbelievably good job of providing the institutional investor and also the retail investor with a nice choice of actual physical metal-backed and now the uranium availability with these metals trusts.
Right. Thanks for mentioning that. In fact, we've just launched an ESG gold physical trust for probably institutional and maybe some retail investors who want to be sure that the gold that they have claim to is squeaky clean from an ESG point of view.
Now, you mentioned investor demand being the demand driver for gold. What about central bank net purchases? Do you think that that's going to continue to be strong? I know since 2020, there's been a big increase in net purchases by a lot of central banks, especially outside the G7 for physical gold demand. Do you think that that trend is going to continue going forward?
Well, it's certainly helpful. I think that the dollar is losing shelf space internationally. I don't think it's going to ever go away. It's always going to be a key currency, but you are seeing more and more, I would say, countries that are not aligned with the Western point of view looking for reserve diversification, and gold is certainly a very liquid way to do that. So yes, I see that continuing.
And it seems that gold is a good hedge against whatever the next global financial system is, because there's just so many problems. If the dollar rallies, there's a dollar shortage. These emerging markets can't service or pay off their dollar-denominated debt. So a lot of these smart countries are diversifying their reserves. They're not buying euros. They're not holding a massive amount of Chinese yuan. They're accumulating physical gold.
Right. Well, gold is basically a hedge against systemic risk. And the level of systemic risk today, in my mind, is the greatest I've seen it since I've been doing this, which is the last 20 plus years. And it really, the way to quantify it is in the form of debt that's been built up by central banks, by the private sector. And what it means is that the potential for defaults and systemic breakdown when that debt cannot be serviced is very, very high. And it kind of means that we're on a kind of a merry-go-round where we have to go faster and faster in terms of debt creation just to keep any sort of semblance of economic normalcy. It should be obvious to anyone who looks at the numbers. I mean, that's the backdrop and the reason to have gold exposure, which is that it's a perpetual motion machine that just can't continue. And when it stops, I think, and I don't know when that's going to be. I mean, who knows? They've been able to keep all these chickens in the air for longer than I ever thought they could, but at some point it's going to stop, the music's going to stop, and gold will be the high ground.
So I want to transition now to your expertise. You were arguably the top gold stock fund manager for a very long time, very well respected. Loved reading your quarterly pieces that you put out in your other research, your King World News interviews in the past. What do you think are the...
I just said thank you.
Yeah, really, I learned so much from reading your pieces. What do you think are the biggest risks right now for the gold mining industry?
Well, actually, I think the gold mining industry is in great shape. They're, let's say, where are we today? Almost 1800, but let's say mid 1700s. The cash cost of producing gold, I'd say globally, is somewhere, let's call it 1,000. 900, 1,000. If you add in all the other costs using ASIC, all-in sustaining costs, it may be, I don't know, 1,300, something like that. So there's still a margin. And what people have been freaking out about is the cost of building new capacity to either grow or maintain a production profile. In my mind, that fear of capex blowout and cost pressures is way, way overstated, because for the most part, CapEx is discretionary. Obviously, once you start building a mine, you have to go complete it. But it may be that we're at a point where, because of the risks involved in building new mining capacity, that the future outlook for mine supply is pretty much flat to down. I kind of think that's where we are today, even though you hear a lot about expansion programs. But I do think that we're probably at a point of static production outlook for the next 3, 4, 5 years. And in the meantime, the industry is generating huge amounts of cash. So I don't see, and just to add to your a further, maybe long-winded answer to your question, is that the stocks are priced as if the risks are huge. And what I've learned in this business is when people are most fearful, that is the time to be a very aggressive buyer. I mean, that's straight out of Warren Buffett. So you have the industry, and we have this on our website for anybody who cares to look. But if you look at the valuation metrics for the gold mining sector and compare it to the S&P, it's far more attractive. The dividend yield is higher. The market cap, enterprise value to EBITDA to cash flow, a number of quantitative measures. The gold stocks are as cheap as I've seen them in the 20 years I've been doing this.
Isn't it? So with these larger producers that have good free cash flow, the larger, lower cost ones that have access to capital, isn't it cheaper for them to just go and buy a mid-tier producer that their valuation is discounted right now than go and build a new mine?
Right, absolutely. And you're seeing some of that. You're seeing some really stupid deals too. But we figure that it's the discount, which is basically what you were just referring to, which is cheaper to buy something on the market versus build a new mine, is as much as 30 or so percent. Not to mention the fact that when you build a new mine, it's a 3 or 4 year process. Whereas if you can complete an acquisition that's accretive to existing shareholders, you have new production right away. So without the risks that you undertake when you have to lay out large amounts of capital to build new capacity. So it kind of makes me scratch my head as to why there hasn't been more of this sort of thing. But you are seeing it. Not all the deals that I see are all that intelligent, but there are some that are accretive. And again, I would say, I think as part of our strategy, we're investing in companies that look good on a takeover basis. Whether it happens or not, we don't know. But certainly, we look at the metrics and what it would look like to a potential buyer. So that is a key part of our investment strategy right now.
Hasn't there only been 2 major acquisitions for mining companies in the gold space lately? You have Yamana Gold was taken out by Gold Fields, and there was a lot of retail shareholders that were not happy with the premium that was paid for Yamana, as they were one of the lowest cost mid-tier producers, and they didn't really need to sell out because they had such low costs and they were, really good mines in Canada and Argentina. And then the other deal that I remember, unless there were more that I missed, was Great Bear was taken out by Kinross, but that mine's nowhere near ready to go into production. That was pre-resource. I don't even think they have a pre-feasibility study yet.
You're correct about the Great Bear, and I know there's a lot of unhappiness with the Gold Fields Yamana transaction. I can't comment on either one. I'm sure my compliance would shoot me if I did. But there have been quite a few. I would say more than what you referred to. So, I can't I can't go through chapter and verse on each and every one, but we've had a couple in our portfolio. You know, you can go back to Detour, Kirkland Lake by Agnico. I mean, that's just one example, but there've been more than you have than the Yamana Goldfields or the Kinross Great Bear.
Is capital available for most mining companies? So if you're a higher cost miner, let's say your costs are $1,500, $1,600 an ounce, you have debt on the balance sheet, you can't control your energy costs. Do those companies have capital available right now? And what about juniors in capital availability?
Well, you know, you're not seeing a lot of deals like you did 10 years ago when just about any kind of low grade moose pasture was able to, you know, you could do $100 million bought deal. You're not seeing that. The deals you're seeing are smaller and more selective. So yeah, I think capital's very tight. Capital's expensive. You can just look at the valuation of equities in the space, and that, I mean, you're nuts, in my opinion, to issue stock at these valuations. And luckily, we're not seeing a whole lot of it. I mean, Kinross was an example where they did issue a lot of stock to complete that acquisition. But for the most part, you're not seeing that. You are seeing, I would say, a willingness by bankers to fund construction of new mining capacity. And so debt financing is available. Usually it carries some hedging requirement, but it's there, but it's not flowing freely the way it was 10 years ago. I think it's very selective.
Do you think in these type of market conditions where capital is not as easily available, does it benefit the larger precious metal royalty and streaming companies like Franco-Nevada, Wheaton Precious Metals, and Royal Gold?
Well, yeah, I mean, in the sense that it's a form, it's a source of capital, which, you know, the three you mentioned, plus a few more, provide streaming deals, which can get a given asset off the ground. So, you know, but that can be expensive. There are some deals I've seen done. I'm not going to mention anyone specifically that I think are, you know, really reaching for the sky in terms of valuation, i.e., overpaying to get control of a good asset by some of the majors and some of the smaller mid-tier royalty companies. But to your point, royalty companies are a source of capital that have benefited from the scarcity of outright equity capital.
Now, you had Franco-Nevada in the portfolio of the Tocqueville Gold Fund for a long time. Wasn't it one of the top, if not the top performing gold stock, even while gold prices were falling? So from, I think, 2012 when 2011 when gold prices started to fall, Franco-Nevada continued to grow. They continued to do more deals. And I think since 2012, haven't they also increased dividends?
Oh, yeah. No, I mean, it's a great business model, and they're super smart guys. And you could say that about some of the other major royalty companies. It's a great business model, and they have benefited from what we just talked about, which is that outright issuance of equity is very, very expensive to existing shareholders, and I would say, and you know, from my point of view, frowned upon. So, yeah, if there's a solution going the streaming route or royalty route, that's probably something that I would encourage, or we have encouraged. Again, capital is very expensive these days, and I would say almost too expensive to justify much in the way of mine expansion. There's no question that there are projects underway that are going to get built, but I can't give you a number off the top of my head as to what that means in terms of supply and demand. But I would say what is going on is probably what's necessary just to keep global mine supply stable. And again, I'd say on balance, I'd say even with what's being built today, I could list a bunch of them, but they don't really move the needle in terms of global mine production because of the capital scarcity we talked about. Another thing we haven't talked about, which we should just mention at least in passing, is that the geopolitical risk in so many countries is so much greater than it would have been, say, 20 years or even 10 years ago. I mean, there are a lot of places that the rule of law is just an afterthought, and so investors are shying away from companies with a bad footprint in terms of where their assets are located. We've seen a tremendous shrinkage in the map of the world that we are comfortable investing in. So that also will add to the argument on future mine supply constraint, possibility of mine supply going down. World is a much less safe place for capitalism than it was 20 years ago, even 10 years ago.
And also because of the pandemic, lockdowns, governments with tax shortfalls, you have the copper price. And a lot of these projects, John, for our listeners out there who aren't familiar, a lot of these gold mines have byproduct. They have a silver byproduct, or they're a base metal mine. They're a copper mine with gold byproduct. So the copper price, 9 months ago, I think it was at almost $5 a pound or right around there, give or take. You had these governments like Chile, Panama, and others just talk about putting on very, very punitive copper royalty taxes, like a sliding scale. So that's also going to prevent miners from reinvesting into those countries, expanding deposits, and building new mines in those countries. And those emerging market countries, you didn't name any specific ones. Maybe you want to name a couple specific ones if you think they're red flags. But that's where the best geology is in Latin America, South America, Central America, and also Africa. Some of the best geology in the world for potential new mines.
For sure. And again, I mean, in terms, if you're thinking about cost inputs, the future copper price, future base metal prices, energy, you name it. That particular issue, I think, will put a floor under prices relative to where they may have been 10 years ago. So that would tick the box for sustained inflationary cost inputs. And that's another reason why I would argue that even though inflation may ebb for a while because of the likelihood in my mind of a global recession, I don't see copper, lead, zinc. I don't see oil going back. I don't see any of these raw material inputs going back to levels that they might have been even 10 years ago.
Oh, I totally agree. Labor costs in a lot of these emerging market countries, you have a lot of these mining unions, labor unions, they want higher wages all the time, especially when commodity prices were higher. They're still protesting that. You have much higher diesel prices. You have higher electricity costs. And a lot of these open pit mines, even if they're an underground mine, I mean, they're burning tons of they're using tons of electricity. And then the open pit mines are going through diesel like crazy.
Right. So, yeah, I mean, there's a floor on, I mean, we could go through, a couple of months when prices on the downside of all these inputs might look really silly, but I'd say the tendency will be they'll settle at much higher prices than they would have 5-10 years ago, and that to me that spells inflation.
Yeah, I think in the medium term, we're going to have the new normal, the new cost structure, much higher cost floors. So that means higher metals prices. Otherwise, the supply is going to collapse. So I think like over the last 3 years, John, especially really since the pandemic and this energy crisis problems here, because there's not enough energy supply with diesel, and then electricity prices are going crazy with natural gas and coal. You have mining costs. I mean, Newmont was mining, I think in the first quarter of 2020, their costs were below 1,000, and now they're right around 1,200. So that's a very big cost increase. And they're one of the lower cost producers. So a higher cost producer, like you said, their costs are up at least 30% in the last 2.5 years or so.
Right, right. I agree.
But the other problem, we should probably touch on this too, since I know you've written pieces on this, is the grades. So you've been in the gold mining industry for a long time. I mean, the grades for gold, the grades for silver, for deposit, when you got in the business, you were looking probably at 10, 20, 30 grams per ton average grades for some of these gold mining deposits. For the silver grades, I mean, I did a research for my patrons about Pan American Silver. I mean, their grades over the last 7-8 years for their average silver grades, they've collapsed too. So that depletion, these older mines are depleting and the grades are falling. That normally means the miners are not going to be able to drastically cut their costs.
Yeah, no, grades very important. Grades are declining. I don't have the numbers at the top of my head, but yeah, the grade discovery of new ounces typically is at lower grades than they were 5-10 years ago. And, lower grades mean more CapEx, conceivably more complicated processing, and so forth. So yeah, the sort of steady decline in grades kind of translates into a higher cost structure, more capital at risk, all of those things, which again would act as a constraint on supply without higher prices. And so that's why, particularly in the base metal side or energy side, you really you're talking about kind of a cost push thrust to the price level, and without price relief, supply is going to shrivel. Gold would be the exception because there's so much gold above ground, and again, it's the playpen for macro traders. But even gold, those laws of cost and grade have applicability.
Yeah, there's a lot of, for our listeners out there, there's a lot of long-running copper and gold mines that the production is starting to decline rapidly. The grades are collapsing. Those mines are going to come offline, and eventually they're going to need to be replaced due to depletion for global mine supply at much, much higher metals prices.
Right.
What gold price do you think would be needed and sustained then for a lot of new mine supply to come online? Would it have to be well over $2,000 an ounce gold?
Yeah, I would say so. I mean, it has to, and it just can't be like it hits that price one day. It has to kind of stabilize. Yeah, probably somewhere above 2,000, maybe 2,500 would be required to attract investment of the scale that would maintain the 3,000 tons a year or so of 3,200, whatever the number is, of mine supply. And you're right, a lot of the mines that were part of that production profile are getting worn out and disappearing. So yeah, there's some number out there, and it can't be just like we're not going to go back to $500 or $1,000 an ounce. I mean, that's ridiculous to think it would be sustainable. What is the equilibrium price for gold production that would stabilize annual output of, I think the number's 3,300 metric tons a year. It's certainly not 1,700. It's certainly not 1,800. It's probably somewhere in the mid 2000s.
Yeah, I totally agree. And the price would have to stay there for capital to be raised to start construction on the new mines, because a lot of these mines don't even have feasibility study yet and construction hasn't started yet. It would take probably at least 2 or 3 years. So we're nowhere near prices.
Yeah, I'd say it's more than even 2 or 3. I think it's the genesis of a new mine is probably 5 years in this world.
Yeah, I mean, Great Bear had a potentially great project, but they're pre-resource. So, I mean, there's a lot of people saying that that's going to take 7 to 10 years before that project is built.
Yeah, that's pretty much the consensus view.
So in these types of environments where capital is constrained, we're going to be looking at higher metals prices to bring mines online. The miners are not building new mines. They're reinvesting in existing mines, maybe upgrading their mill, investing in exploration around the mine. Do you think that the safer play here are these larger royalty and streaming companies, because they're going to benefit from capital being constrained, metals prices if they don't go up high? Do you think that royalty and streaming companies are safer than mining companies?
Well, I don't know if they're safer. I just think it's for a generalist who doesn't want to get into the nitty gritty of mining, which is a very capital intensive, difficult business. It's a better business model. I think the counter argument to that is, and it's just a counter argument, it's not definitive by any stretch of the imagination, is the valuations of royalty and streaming companies is higher. Equities carry a higher valuation than most mining companies. Certainly, that's very much the case today. But I think it's over time, it also stands up. So I wouldn't necessarily argue. I'd say for a generalist who doesn't want to get caught up in the weeds of this very difficult business of extractive business of gold mining, royalty and streaming companies are probably a pretty good place to be in. As you mentioned, Franco has been a fantastic stock, as has been Royal Gold and Wheaton Precious, just to mention the big three. But I would also, on behalf of the gold mining companies, you get a lot of torque if for a given move in the gold price, and probably more torque than you would get in the royalty companies. And I'd say for people who have more of a risk appetite and a belief that, which I would share, that gold prices are too low and they're going to go substantially higher in the next couple of years, I think again, you have to be selective, and there are good mining companies and there are not so good mining companies. But I think if you own good mining companies that understand how to allocate capital and do all the things, the blocking and tackling that's basic for success in that business, I think you get more bang for your buck if you have a view like I do that the gold price is way too low right here and now, and needs to settle more, as we said, in the mid 2000s to kind of stabilize global mine production.
Especially given how much central banks printed in the last 2.5 years, the trillions. I mean, the silver price was one of the worst performing commodities the last 14, 15, 16 months. So it has not offset inflation at all.
No, in fact, it's astonishing. I thought you were going to say for the last 10 years.
Well, yeah.
It's been a dog. And as some of my colleagues who are focused on silver are super frustrated by that. But again, silver during a positive phase for monetary metals, gold and silver, and I suppose platinum and palladium, silver has more torque than gold, especially since it's been such a disappointment and so much out, kind of in the penalty box for so long. I just think that it takes a lot less capital to move the silver price than it does the gold price.
As a gold stock fund manager, do you think that buying and holding a lot of these gold miners, the average retail investor, is there a lot of risk involved who doesn't understand the business? Because I mean, there's just so much volatility in a lot of these stocks. If metals prices go down, if energy costs go up, the shares could just collapse way more than maybe the cost. The market gets worried about a dividend cut. The market gets worried about margins. This is what I hear from a lot of retail investors, is that the volatility swings for these mining stocks, buying and holding them, is just too difficult.
Well, I'm speaking from somebody who's done that. It requires a cast iron stomach. And frankly, I think that's why mining stocks are, again, so much in the penalty box, and there's so little interest in them because they have not delivered terrific returns, certainly in the last couple of years. But again, for someone who has a macro view that gold is underpriced, that the systemic risks out there will lead gold to go to a much higher level, a very good way to position yourself is in gold mining stocks. And obviously, you can just own physical gold. You can own the Sprott Physical Gold Trust. You can own GLD. You can own, any one of the ETFs out there, VanEck, GDX, that kind of thing. It's all part of the same theme, and it's what you as an investor are comfortable doing. And again, I would just sort of rank them in terms of potential return. I'd say gold mining stocks, particularly an actively managed fund like ours, I think you probably have a pretty good shot at getting good returns. You probably have a pretty good shot at getting decent returns just by doing an ETF. Sprott has a bunch of ETFs that are mining companies as well. I mentioned a competitor, VanEck. That's the one everyone looks at. And then, if you just want to, basically take a more conservative approach and just protect capital, then physical gold is a perfectly good answer.
As we wrap up here, you put out a very interesting piece in the last month about how you think gold will bottom, gold will have another bull market. Do you want to just talk about it? And I'll put a link to the article you put out in the information and description section below the interview.
Okay, thanks so much. What I basically was trying to address is the setup for gold has been terrific this year. We've had all the things that anybody of my thinking, thought process would have said, this is a perfect setup. We had inflation, we had a bad stock market, we had crypto falling apart, just to name a few things. And gold was just, couldn't have given a worse account of itself. And so what I basically tried to do in that fairly brief paper was to say that, we're just in the early innings of this ball game. And what lies ahead is, again, all my opinion, the Fed will have more egg on its face than it has ever had. Confidence in that institute. Why people pay so much attention to it is beyond me, but they do, despite all their policy mistakes. And I think they're in the middle of making another really big one. So we have yet to see the flip-flop, but I think it's coming. We have yet to deal with the recognition that despite maybe lower prints in the CPI, it's not going to go away, and it's going to be hounding policymakers and maybe upsetting the general public for far longer than anyone cares to think. We have the potential for, despite we're in the middle of a bear market rally, for stocks to go much lower. That I could talk about for another. We don't have time, and I don't want to take up the time, but so you have many things out there, and you have all this debt. I guess the right word is kind of like a unexploded bomb that will have to be addressed at some point. So much of the subprime debt is financed on the short end of the curve, and that's what's rising. And a lot of companies that are dependent on short-term financing in a period of extended economic weakness, or call it a recession, are going to go out of business and people go out of work. So all of that I think lies ahead, which will, I think, generate interest in gold and precious metal stocks.
Yeah, historically, big currency swings, volatility in asset prices, that's normally good for gold as people go to gold for a safe haven and for the fear trade.
Right.
Well, John, I really enjoyed our discussion today. Thank you so much for your time. And I will put a link to your articles. You're still cranking out blog articles for Sprott once a month or once every couple months?
I try to do it maybe a couple times a year. So there's typically it's quarterly.
Well, I want to thank you for educating people like me about the gold mining industry and gold stocks. You've really helped us out over the years.
Okay. Thanks, Jason. Appreciate it.